Hi, I'm Jimmy. In this video, we're going to walk through why the stock market may keep moving higher despite the fact that we've been on a crazy long bull run and the stock market is frankly due for a pullback. So in a recent video I did called Should I Invest Now or Wait Until Later? Well, we reviewed 5 economic indicators that are designed to help us better understand the possibility of when a recession might come. And the results were not too promising. In fact, 4 out of the 5 economic indicators look like they could be bearish indicators. And the one bullish indicator that we did have, well, it wasn't terribly strong. But after I did that video, I came across another piece of information that I thought could be interesting for us to look at. So basically, here's what we do. We take the yield from the 30-year treasury bond and we subtract the average dividend yield of the S&P 500, and then we end up with a chart that looks something like this. So when we get to a time period like this, where the spread goes below zero, well, this would mean that the dividend yield of the S&P 500 was higher. It paid a higher yield than 30-year treasuries. So in theory, what this spread tells us is that when we see the dip below zero, well, more people should be incentivized to buy the S&P 500 over treasuries, and hypothetically, you should see a spike in the price of the S&P 500. Now, I was curious if it really worked this way, so I started looking at returns of the S&P 500 at dips like this or this. And then I started wondering, does it only work when the spread goes negative? What about a dip where it was a relatively large dip compared to its recent history? Something like here, here, or here. When we add the S&P 500 price chart to this chart, well, we can start to take a little bit of a closer look. So what I did is I went back to each of these time periods, and then I looked at the returns, looking out 3 months, 6 months, and then 1 year to see how the S&P 500 performed from each of those individual dips. Now, these different color lines on the chart here, well, the colors don't actually mean anything. I just changed them up so we could keep things a little bit clearer as we add some numbers to this. You'll see what I mean in a second. Hopefully the colors help keep the whole thing a little bit cleaner. Okay, so for the first time period, this is the pink one here, and that was back in 1993. Well, here we had a dip in the spread, and then when we check the returns for the S&P 500 going up 3 months, 6 months, and 12 months, that's what we end up with. Well, the returns were not too great. So they were about flat for the first 3 months, and then after 6 months, well, they were down a bit over 5%, and then they were down just slightly after the first year. So just so we're all on the same page, each of these return numbers had the same starting date. So I took the starting date, which was the low of the yield spread. I took the starting date, added 3 months, and then I said, okay, same starting date, 6 months, how'd they do there? How'd they do in a year? So I took the same starting point. So for that number, we know they were down about 5% for the first 6 months. Well, they must have done okay in the last 6 months since they were only slightly negative for the 1 year number. Okay, moving on. Now, I'm going to go a bit quicker through each of these numbers just so we can get to some conclusions with this whole thing. So in the next time period, we begin to see things do a little bit better. In that period, they were up 6, 8, and 23%. Then we saw another dip in the yield spread in 1998, and the dip resulted in returns of 22, 30, and 28%. So pretty good. Then when we jump over to 2002, once again, we saw a rally of 6%, followed by 13%, and then 17%. Then in 2008, we saw the yield spread dip into negative territory for the first time in our entire analysis. And there they produced a negative 12% return, then a positive 8, and a positive 29%. We'll come back to this one in a second. I just want to wrap up the dips. So back in 2016, we saw once again the yield spread dip into negative territory. And here we saw a 2% return, 6%, and then 14%. So once again, pretty good return numbers. Okay, jumping back to the Great Recession for a quick second. So if we were to zoom in a bit, well, here we can see that the spread went negative and it stayed there for a little bit. Now, when I calculated the return, I did so from the lowest point. So that was right here. But as we could see, the low of the S&P 500 didn't happen until right here. But we can also see that there was another dip lower at the low of the S&P 500 that coincided with the dip in the yield spread as well. So I bring this out, and I wanted to make a video on this in general because one of the things that I've learned about investing is that very few things are black and white. Very few things are clear-cut and it's a defined rule. Almost every rule in investing has an exception to that rule. And When we do a video and the evidence seems to overwhelmingly point in a recession is coming in the near future, well, then we find something like this whole yield spread, and we realize that perhaps this is indicating that the market has a reason to keep moving higher. Now, as we could see with this particular yield spread, it doesn't always work. We saw back in 1993 that it didn't work terribly well in that scenario. Or even in 1998, well, yes, the returns were positive and they were great returns for the time periods that we selected. But if we had continued our analysis going out 2 or 3 years, well, that's when the tech bubble happened. So clearly the numbers would not have been that good then. So I think it's important for us not to develop a bias with this either. So clearly this indicator isn't bulletproof, but I do think that it's worth keeping in mind. And I did find it quite interesting when I was first just looking at this chart. When I first created it, I was just eyeballing it thinking, wow, yeah, it seems when there's a dip, the market seems to rally. Now, if we consider that in August, just a couple weeks ago, well, this yield spread once again went negative. Now, right now, it happens to be slightly positive. We're not sure. We don't have the benefit of hindsight like we do with this entire chart. Was that the low? Are we going to go back into negative territory? We're not 100% sure. But if it is possible that this helps drive more buyers into the S&P 500, and perhaps the market continues to rally. So where do we think the S&P 500 is going to be in 3 months or 6 months or 12 months? The Federal Reserve has started to lower interest rates once again, and clearly the stock market wants to keep moving higher. Most people are interested in the stock market moving higher. So despite the fact that a pullback is probably well-deserved, it's probably overdue, but maybe it could keep moving higher if we believe this indicator. But what do you think? Where do you think the S&P 500 will be in, let's say, 1 year? Will it be up or down, and by how much? Maybe we can get something similar to what happened in 1998, where we had a big rally after the yield spread had a big dip, and then the stock market really fell off during the tech bubble. But I'm not sure what's going to be the tipping point here. There's clearly going to be a tipping point at some point. The market's going to pull back at some point. But what's going to be the trigger? Please let me know what you think in the comments below. If you haven't done so yet, please hit the subscribe button. Thank you so much for sticking with me all the way to the end of the video, and I'll see you in the next video. Thanks.